Hello, let's talk about the AICPA Code of Professional Conduct and how it guides auditors in performing audits. In this video, we'll talk about the rules of conduct and specifically Rule 101, independence. Different professional standards apply depending on whether the auditor is conducting a private company audit or a public company audit. Auditors who are conducting a private company audit must follow the audit standards of the Audit Standards Board, ASB, or generally accepted auditing standards, as well as the standards of professional conduct by the AICPA, as well as the Independent Standards Board. The public company audits follow the auditing standards by the PCAOB. These PCAOB standards are actually very similar with a few notable exceptions related to the AICPA standards. Public company audits also follow the standards of professional conduct by the PCAOB, SEC, and ISB. The Independent Standards Board was a cooperative effort between the AICPA and the SEC. The board is now defunct, but the standards apply. My focus today is going to be the AICPA rules of conduct and specifically independence. But let's first level set where the rules of conduct fit in terms of the AICPA Code of Professional Conduct framework. The framework starts with 6 principles of professional conduct, which are responsibilities, the public interest, integrity, objectivity, and independence, due care, and scope and nature of services. These principles of professional conduct apply to all members, regardless of whether the accountant audits companies, prepares tax returns, works for a private company, or is an educator. These principles flow to the rules of conduct, and from the rules of conduct, we get more granular in terms of interpretation, as well as rulings by the Professional Ethics Executive Committee. There are 11 rules of conduct, which are independence, integrity and objectivity, general standards, compliance with standards, accounting standards, confidential client information, contingent fees, acts discreditable, advertising and other forms of solicitation, commission and referral fees, and form of organization and name. Today, we'll discuss Rule 101, independence. Rule 101 states that a member in public practice shall be independent in the performance of professional services. However, not all CPA services require independence. Independence is required for financial statement audits, financial statement reviews, and attestation services. The interpretations for Rule 101 provide us with additional details that state that covered members must be independent. What does that mean? Covered members are those individuals who are on the attest engagement team, including individuals in a position to influence the attestation engagement, such as the partner that's doing reviews. Covered members also include other people within the organization that are a part of the process, although they're not necessarily in the day-to-day operations of the audit, such as a partner that provides non-attest services or a partner in the same office as the lead attest engagement partner, the firm itself, and an entity who is operating financial or accounting policies can be controlled by any of the covered members or entities. What are some of the prohibited financial relationships? A direct relationship is always prohibited. For example, if the individual owns stock in the organization. A material indirect relationship is when the stock is owned through a mutual fund and the amount of stock within this mutual fund is material in relationship to the overall wealth of the covered member. There are certain exceptions, though. A covered member can have an automobile loan, as an example, or have a loan that is collateralized by a life insurance policy or cash deposits, and also have a credit card as long as the balance drops below $10,000 at the end of each month. Then this would be an exception related to a prohibited business relationship. Rule 101 and the relevant interpretations indicate that a CPA's independence is impaired if the CPA performs a managerial or other significant role for the entity's organization during the attestation time period. Interpretation 101-2 states that the firm's independence is impaired with respect to an entity if a partner or professional employee leaves the firm, is subsequently employed by or associated with that entity in a key position unless several conditions are met. The member's immediate family is included in the covered member rules, including spouse, spousal equivalent, or dependent, is subject to Ruling 101 and its interpretations. For example, you could not complete an audit of an organization if your spouse is a controller or CFO. Also, the spouse, spousal equivalent, and other direct dependents could not own stock in the organization. Beyond the immediate family are close relatives, which are defined as non-dependent children, brothers, sisters, parents, grandparents, parents-in-law, and their respective spouses. There are two major situations that can impair independence in terms of close relatives. A, close relative has a material financial interest in the entity, and the CPA participating in the engagement is aware of the interest. Or the close relative can exercise significant influence over the financial or accounting policies of the entity. That would also impair the CPA's independence. Litigation, actual or threatened, is another category that impairs the CPA's independence. There are three categories. The first one involves actual commencement of litigation by management alleging deficiencies in audit work for the entity. The second category of litigation involves threatened litigation that is deemed probable by the CPA. The third category is actual commencement of litigation by the CPA against management alleging management fraud or deceit. The AICPA Code of Professional Conduct restricts the types of non-audit services that can be provided to attest entities, and the SEC is even more restrictive in terms of independence rules for audits of public companies, meaning those trading on the exchanges. The PCAOB and SEC have 9 prohibited non-attest categories of services. This means that the audit firm cannot provide these services to the publicly traded companies if they are also handling the audits. These prohibited services include bookkeeping, actuarial services, broker or dealer, financial information system design and implementation, internal auditing, outsourcing services, legal services, appraisal or valuation services, management functions or human resources, and expert services.